Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focus Compounding, sitting next to my co-founder, Geoff Gannon. Jeff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great for everybody else as well. Hey, if this is the first time you are tuning in, hit that subscribe button, thumbs this video up. If you're watching on YouTube, bringing you guys a ton of content. If you are following this on the podcast side of things, of course, a rating and review goes a very long way. I'm going to try my best not to touch the microphone this time. It's kind of jumping around and it was driving me bananas listening to it. But we're going to see how well I do. Today is a Q&A. We normally do them on Monday. So if you want to be on the lookout for that, the best place to see that is my Twitter at Focus Compound. And then the other thing is, and this is the first time that we are actually announcing it, if you want to support the Focus Compounding movement, not the Focus Compounding the movement. If you want to support the movement and you like Quick FS, that is quickfinancialstatements.net, and you go and you sign up, you should see a part of how did you hear about us?
Okay.
And there will be a new thing in there where you could click Focused Compounding. If you want to do it that way, that's the best way to do it. Or in the show notes, you'll see a link. And I guess if you click it, it puts a cookie on your page. It tells them that you came from us. And Jeff and I get a little piece of that. Because, I mean, we promote it so much. We love it so much.
Yeah.
And the guy that runs it's been great. And we're happy to continue to promote it. So we are now... What are we, affiliates? That's, I guess, what we are. We have sold out. We've lied. We've sold out. And if you want to support us, if you want to get Quick FS, you could support us by signing up through that link or just saying that you heard of us or heard of Quick FS through Focus Compounding. When you actually sign up, you'll see a part to click that. So the first question, we'll get right into it. We have a lot of good questions, 45 questions, I think. So we'll do our best to plow through it. It says, how do you think time horizon should influence your cash position? We've had a lot of questions on time horizon.
That's a very good question. I mean, the biggest issue is if you're going to, well, there's sort of a couple issues, but the biggest issue is the risk that you'll spend money that you have invested at prices that are, well, you will spend more relative to intrinsic value than you should. So the risk is if you have a need for cash at a time when stocks or bonds or whatever you're invested in is priced above intrinsic value. It's not so much of a problem if it's priced below intrinsic value, because the reason is you're spending part of your market value. You know, that's how you plan for these things. So you think like, I'm going to spend a certain amount of my market value, but actually if the stock is overvalued, then you're actually spending a higher percentage of intrinsic value when you do that, and vice versa. So it depends. It's a combination, but basically you should be concerned if you need cash quickly at a time when the assets you're in are priced higher than normal.
I think this question could also come from the other day. Mm-hmm. When we were talking about how to live off of your investments. Right. And you were talking about, you think, I believe it's what you said, tell me if I'm wrong, that the pull 4% from your account thing is going to be dead over the next 10 years. Is that what you said?
Well, this was someone who was actually in their 30s who wanted to have like a permanent retirement, basically. Yeah. Now, if you're in your 70s or 80s, it'll be a little different. But when you're like in your 30s, what you basically need is a perpetual source of funding, because the time of your retirement will be so long. So yeah, I think it's very hard to spend 5% or 4% or whatever in the 2020s unless stocks or bonds or whatever you're in gets a bit cheaper. Given what the prices are now, it'll be kind of tough.
And then he also asked also thoughts on negative return on equity.
Well, it depends. If it
could be two ways, right?
Right. If it's negative return on equity because there is an equity in the business, then it depends. If the business is some sort of franchise, it doesn't really matter. I've invested in a company at least once that had negative return on equity, and I didn't mind it. Buffett invested in a company that had no equity at least once. He may have done it twice. I don't know if Moody's had equity when he invested in it. I know that Gillette did not have equity when he put in his preferred.
Got it. Next question says, what is your advice for someone interested in starting a hedge fund?
My advice would be to partner with people who.
That's exactly what my answer was going to be.
Okay.
Partner with someone like Andrew. No, I know that's not what you're saying.
No, that is true.
Oh, really? But that wasn't your answer, right? All right, go ahead. Sorry, I cut you off.
Both with Andrew and with Willow Oak.
That's right. Andrew's taken though.
So, partner with people who do those sorts of things. Unless you have a background that's the reverse. If you have a background that's we happen to know who this person is, and he's not a lawyer or anything. So I would give that advice. But if your background was more in the sort of services of helping people out with that kind of thing, then you need to partner with someone who has the reverse skills.
So from actually, being a part of Focus Compound and stuff, it's actually like I've thought about this before. I don't know how anybody does do it by themselves and focus on investing. Yeah. Because even like daily stuff with not daily, but stuff often with like inflows and the administrator and sending this wire and doing this and doing that. Mm-hmm. It's not. It takes up a lot of time. Yeah. So I guess partnering with the right individuals. But I think your fund, in my opinion, is only as good as the capital that you have. And what I mean by that is the type of capital that you have. Yeah. So my advice to anybody would be really think of ways that you can try to influence. Just getting the right type of capital, because not all capital is equal. And what I mean by that is there's hot money is what some people call, where they may be shorter term capital. And the way that we've been able to set up our firm really through this idea of content marketing is it allows investors to self-select us, where that's the only outbound marketing that we do is producing content. Every single one of our clients, whether it is the fund or the managed accounts, other than maybe family members or whatever, has come to us because they listened to the podcast, they've been reading Geoff for a long time or whatever. I just got off the phone with somebody on my way here, and he was telling me that he's been reading your stuff since, early Guru Focus days. Mm-hmm. So I would really tell individuals, think long and hard about how you can try to influence the right type of capital that's going to invest with you. I think every one of our investors in some capacity is an investor themselves, whether that's venture capital, whether that's a family office, whether that's a fund of funds, whether that's they invest their own money. Every one of our investors is like that. So that is what my main advice would be. It would be get the backside right, because that is more than 50% of your time. And if you're doing it by yourself, I don't know how you focus on investing. It would be tough. It'd be very tough. But then think long and hard about how you're going to create maybe more sustainable, longer term type of capital to invest with you, I would say. Yeah.
And I would say from the beginning, we probably, in both managed accounts and fund, we wouldn't have regretted having the same or higher minimum ever. It's very tempting to have a very low minimum and stuff and bring in more people, but it's a lot more work to do that. You may bring in people that you don't necessarily aren't the same kinds of people that you want. So it's tempting at first. People will tell you to do whatever it takes to bring in as much as possible up front, but you want to make sure you have the right kind of people and stuff.
Privately, I always talk about this story, and I won't get too in depth in case he listens to the podcast still. But with Geoff, when we didn't even have $1 in the door, we had zero revenue. It was just when we first announced that we were going to start the managed accounts, and there was a certain individual that there probably could have been a lot of capital behind it. And we ended up turning him away, respectfully, because he wanted veto rights. He wanted us to send a write-up every single time we were going to invest, blah, blah, blah. Just stuff that you don't want for yourself. Because again, I would think long and hard, yes, the individuals that reach out are interviewing you, but you're also interviewing them. And I think that's something I've had to personally learn and think about more. And I've gotten, great advice from other Ian Castle, he's been on the show and he's given me good advice on it. Just to really make sure, look, we always say this, we want to do this for the next 50 years. And the only way you're going to get there is if you had good partners on both sides. You're good for them, they're good for you. And that's really what I would focus on. This is my favorite question that got asked. Okay. He said for hashtag GEOFF. That's my new thing. When people ask me, I'm going to say I'm long money sign GEOFF. I'm long Geoff. It says, and this is a question for you only. Everyone knows how excited I was. On a scale of 1 to 10, how great was it to see Andrew again? 11, 12? How much, Geoff? Come on, tell him.
I don't think I've ever hit an 11 or 12 on anything in my life, level of excitement. But an 8.
An 8. Okay, that's pretty. I'll take an 8. That was a lot higher than I thought it was going to be. All right, cool. I'll take an 8. That was a good question, Ben. All right. Next question. How does Geoff think about cost of capital? Does he ever use WACC? Should an individual use desired return as cost of equity or use expected return in comparable investment like the S&P 500? Present values change a lot if cash flows are discounted at 10% versus using 10-year treasury.
Yeah, that is true. It's a huge difference. I was just reading something where Munger talked about this. He actually, it wasn't so much a speech, it was like a debate thing that he did. Cost of capital has always bothered him. And it does, I guess, bother me as well. It's complicated because some companies can use debt, and we buy into companies sometimes on the anticipation that they will sometimes use debt, and that their investments will have much higher returns than the debt they use. And this is always the case with things like utilities and railroads and things like that, but other companies too. So there are companies we wouldn't invest in if we didn't think they would use some form of leverage. That even applies with things that like lease locations and stuff. So for us, though, I would say we use opportunity cost when making decisions and when making judgments about whether we want the company to buy back stock or pay dividends or whatever. And usually it's something that is basically the same sort of safety, or however you want to call it, confidence that we have in it at delivering that same return. I think it's pretty hard to judge the risk adjustment stuff. Buffett doesn't use a risk adjusted rate. It's very hard to do a risk adjusted rate. So if we have something that we think is just as safe and could return 11, 12, 13% a year, then that would be the cost that we'd be looking at in terms of an opportunity cost, whether to buy the stock or not. So it does sometimes happen that there's a stock that looks like it could offer pretty good returns, but it's not as safe. And so that's the judgment that you have to make. It's basically our opportunity cost, and it's our next best alternative that we use. And it's usually literally an actual other company I compare it to, another stock that we might own more of, especially so that we already own.
I think Buffett this past weekend actually said, I've always used the treasury.
Yeah, he did say that. It's complicated because I sometimes talk about intrinsic value, which is not something I think about that much. I don't really need to know the intrinsic value. I just need to know what you should put things in. But in theory, for intrinsic value, it should be the price at which it equalizes the return between the stock and the S&P 500. So if you think the S&P 500 is going to return 8% a year over the next 15 years, then the stock should also return 8% a year at your intrinsic value estimate.
He also asked, maybe not relevant, but I'm also interested in whether Geoff has considered real estate investing, not REITs, but buying and holding, say, apartment rentals. Does he focus on stocks because of interest/personal preference, or because he thinks the returns will be greater?
I think the returns will be greater. I think I understand it better. I think a lot of the money to be made in real estate is doing stuff I don't want to do. So I think passive ownership of real estate as compared to passive ownership of stocks is going to work better. That's not arguing that active development of real estate and stuff isn't going to work out well, but that's not the kind of thing that I would do. It's not impossible that we would buy real estate stuff through the stock market, though, but that's different.
Somebody asked us to do more like the Transcat. We went through a marked up 10K. We could definitely do that. Okay. Do you have a 2024 S&P 500 target around the next election?
No, I do not.
No. What does Geoff think of non-U.S. equity markets?
I think they're not my area of expertise, but I think they're very cheap generally compared to U.S. equity markets. I think that there is... and for a U.S. investor, I think the dollar is also strong. So I think unhedged investments in foreign equities is probably going to give you much better returns than investing in U.S. equities right now. But it is not an area I know very well. I try all the time to cultivate relationships, or whatever you would say, with people in countries that I think are promising. But generally, for most countries, there's some exceptions. It's just too difficult for me to feel that I have as much information as the local investors in that market.
Somebody asks, he says, a couple good mentions of time horizon in here. He says, Geoff is pretty bearish. How might he advise a young lad with a lot of cash, like too much cash, plus time? So if an individual has maybe someone in their 20s, 30s, they're sitting on a lot of cash, looking to allocate that capital, how would you advise them with you being bearish on the market right now?
I don't think you can have too much cash for someone who's really young like that. I think just save up cash, live below your means as much as possible, and you'll probably have an opportunity in the next few years to deploy it in something.
But I was talking about this with Vetla on the Rundown, which is the #1 rundown show on investing in the world, which is pretty interesting. Only recorded 2 shows and we're already that good. Check it out. But I was saying the topic of something you said recently was this is the most bearish you've ever been on the stock market in your 20 plus years or whatever of investing. Okay, you said that on the podcast. Okay. But I said, Geoff may think that, but I don't think that doesn't mean if we didn't find an opportunity that you would buy stock. Oh, that's not that at all. Did you draw that conclusion because you're looking at a lot of companies, and a lot of companies that you've been looking at, they just don't seem cheap?
Yes, and
combined with macro data, or what? Like, where are you drawing that sort of top-down approach?
Yeah, from? I mean, some of it is macro data, like you were saying. I maybe am more concerned about the economy in some places and stuff, and I'm surprised by the lack of reaction in certain.
I mean, we're down 12% on the year.
Yeah,
literally, we're back to like 2019 levels.
Yeah,
I mean, the market last year was up massively.
Yeah.
So
now there is a lot of stimulus and a lot of credit expansion. So that tends to inflate asset prices and things, and there's a lot of optimism that people have. It's even more than that, like bearishness or something like that. I've never had this surreal an experience in terms of for any extended period of time. It's happened on given days or a week, but I've never had this surreal an experience in terms of what I'm seeing and thinking I'm seeing, and what the consensus more generally is. It's really surprising. I mean, we could talk about some stocks that we like and stuff because there are prices that we have little hope of buying them in some cases. We really like Hilton Foods. Mm-hmm. It's pretty much at an all-time high. It's a meatpacking company.
It didn't even fall at all. Like, that was like one of the only stocks that just like did not move when the whole world was crashing. I mean, we were following
like a moment.
Yeah,
like Buffett was talking about with the liquidity thing. There was like a moment. If there was a particular day, if you look at the low or something, where you can see it, but it did not trade for long at any price that was very attractive.
We were watching it when like everything was happening, and we were on a podcast, and I accidentally said the stock name. Do you remember that? What were we talking about?
Ackman, because he owns Hilton.
Yeah, we were talking about Ackman buying Hilton, and then I kept saying Hilton Foods, but not. And then you're like, I think we're talking. And I was like, oh, whoops! I just came to tell which company we're trying to buy.
Yeah, there's a bank that I like quite a bit in Fort Worth, in Texas, which is not far from here. And it lends very, very heavily, like overwhelmingly, to small businesses and stuff involved in construction. The construction industry in Fort Worth and in this area, this will be the worst. I mean, it's got to be the worst in 30 years. Like, in terms of real estate and stuff, nothing like this happened in Texas in 2008, 2009. There wasn't much of a recession here. So this is going back to to a recession in which most of the big Texas banks failed and stuff. Mm-hmm. Now that won't happen this time. The banks won't have that problem. But in terms of real estate and stuff, this isn't something that people are used to in Texas. Mm-hmm. Seeing whether it's declines in retail stuff or in office space stuff, the kinds of things that Buffett talked about. Because it's also combined in Texas that a bigger part of the economy in Texas than in most states is also directly related to oil too.
Mm-hmm. But to answer his question though, you would just what would the bottom line be?
I think there's very little cost to holding cash for. I mean, if you end up holding cash for 3 years and then deploying it, I don't think you'll end up much worse than other people. I talked about it in an email. My estimates for returns were low. I said it could be as bad as, looking out 5 years or 10 years, returns in equities could be as bad as like 0% a year. They could be as good as 5% a year. I don't think they can be a lot better than that. And so you're not giving up a ton that way. Now, on the other hand, we can see why this might be happening. I mean, we talked about we have a fund and stuff. I bet we can borrow on margin at a little less than 1%. Mm-hmm. So if we were into that kind of thing and speculating and stuff, it's not hard to find things that yield a lot more than 1%.
Sure.
So I'm sure that there are funds and stuff that do exactly that. So, those rates and things are part of it.
And that's a good segue into the next question. In your opinions, is there reasonable and safe ways for retail/schmuck investors to use leverage in their portfolio? Options.
So, yeah, I mean, you can. Like we have talked about leaps and stuff. You can use that. I want to be very cautious about leverage. If I was investing my own money personally without clients and things, is it possible I would use leverage in some situations? Yes. Buffett did. Munger did. In fact, in their partnerships, Buffett had a habit of offsetting his workouts, which were things like merger, arbitrage, and liquidations and stuff. And I don't see necessarily a very big problem with that. There are ways to use leverage that make sense in some very safe investments. One of the issues, though, is that actually the things that probably would benefit the most from leverage in terms of safety and the returns that you would get from it that we see are actually not stuff that you can use as collateral. So there's some stuff that's extremely illiquid, obscure, whatever, but almost guaranteed to yield a lot more in perpetuity than what you'd have to finance it with, and the price is unlikely to be correlated at all with the market. There are ways. I mentioned a preferred stock or something, I think, before. It had at its best moment, it got to like a 9.5% yield to worst probably, and it's not callable for like 6 years or something. I thought it's very safe. It's backed completely with rents from apartments. And, I'm not advising people to use leverage and stuff, but if someone said that they were buying that preferred stock on margin, I wouldn't argue that's more dangerous than the S&P 500. In terms of certain volatility things and stuff, it's probably safer.
Mm-hmm. Someone asks, every time Elon tweets something crazy, would that be considered a buying opportunity?
I'll leave that one with you.
Why are you leaving this with me? I already brought in the bad Tesla crowd.
Well, he said something that I probably agree with, right? He said that the stock was too expensive.
Yeah.
And
I broke the cardinal rule of starting a podcast, which is if you're a value investing podcast, never talk about Elon Musk and Tesla, because apparently a lot of people get offended. Just kidding. I'll always talk about it. I don't care.
Some of my favorite CEOs have said our stock's too expensive. The CEO of Bowl America said
all right, but it's a little bit different.
Buffett said it. Munger has said it.
Yes, but it's different. You don't think it's different? The way that he has, the dude faked. I don't care. I'll talk about it. I'm bulletproof.
I think he was trying to get attention.
Thumbs this video. I don't care. 420. He faked the 420 buyout.
Yeah.
Okay. I talked about this in one of my videos. The whole marijuana thing with Joe Rogan, whatever. I don't care. Okay. I'm not here to judge that. Faking a 420 buyout and lying about it, saying funding secured when it clearly was not secured. I mean, come on.
Yeah.
Him saying that, the other day, him saying, and look, this stock has such a cult following on both the short and the long side. So anything that he does, the short's going to, be upset about. And anything anything that the shorts say, the longs are going to be upset about. I get that, okay? Whatever. I hope Elon Musk is successful. The product is cool. Yeah. Maybe I'm getting a little gun shy. I take some pre-workout, come back on, and I'm gonna freaking fire off. I'm just kidding.
But I mean, we promote Quick FS. If you look at Quick FS at Tesla, it's at the actual price, it is too high. I mean, you can't make. I mean, the price to book is in the double digits, I believe.
Well, even Elon thinks it's too high.
Yeah,
apparently.
Yeah. I think there's reasons for saying it were different than mine would be or something.
Yeah, because he went to go raise capital and they probably told him, you're crazy, Elon. Your stock's too high.
But if I was in his position...
Speculation, it's a joke.
If I was in his position, I'd be having a nervous breakdown because nothing that you can do is going to please your shareholders over the next 10, 20 years or whatever, even if you make an incredible company out of it because of what the price is,
Look, it's admirable the way the guy's like sending rockets to the moon or wants to go to Mars and constantly puts everything back on the table, right? Mm-hmm. He constantly bets it all, which to me, that's kind of crazy. Like I always say, okay, so a dude with $30 billion, I think you have more risk on the line. It's like your lifestyle. Okay, so you're gonna go from 30 billion to 60 billion. Like, is your lifestyle gonna change? No, you could just give away more money. But to him, I mean, the guy believes that he has a mission that's bigger than himself, which is like totally I admire that about him.
Yeah,
the guy wants to go to Mars, so I hope he's successful.
He also likes attention, though.
Yeah, and that is what's fun about it. Like I said, 2020. I mean, just everything in general. It's been very entertaining, and Elon Musk never fails at that. So I hope he's successful. I would drive a Tesla. Have you been in a Tesla?
I have never been in a Tesla.
They're cool. I would drive one. Why not? Except for, I mean, it's pretty expensive. Some of their cars are like what, $70,000?
I don't know. If you want, there's a Tesla dealership right across the street if you want to.
Yeah. Anyways,
it's not a dealership. It's a whatever. You have to go inside and stuff. It's like a mall,
Yeah.
Actually, there's two right around here.
Do you expect this crisis to permanently change some consumer habits? An example, no more in-person branch banking, no more latte every day from Starbucks. Could be talking about you, etc.
No, I don't expect it to change that sort of way. I do think that there'll be some reduction in some stuff like use of how many employees you need in your offices and things like that. And those reductions can be big because even if you say you just need 90% or 80% as many as you had before, you can have people, you can shift having people work from home as long as they live very close to the office and stuff like that. There's some other things that might change a bit, call centers and things like that. But I think in the long run, the other stuff that you're talking about will go right back to normal.
Yeah.
So overall, I know that we talk about me being bearish or whatever. I generally have a more extremely negative view of what could happen, the range of possibilities in the short term. But actually, I think Howard Marks says something similar in that, like, the idea that the world will be changed by it in 5 years, something I don't see, because you'll either have a vaccine or you'll have infected just about everybody, in a few years.
Mm-hmm. I would agree with that. Let's see. I know some super investors have switched from classic value to compounders, but never vice versa. Why do you think this evolution process occurs? Does this suggest to you that one is superior? In your opinion, should new investors skip the value stage?
No,
I just think it's because it's worked.
It's AUM. I actually was looking at something where I was doing a back test, and a very simple thing that Graham laid out has outperformed the compounders by quite a lot over the last 15 years. So when applied to obscure stocks, now when applied to the biggest stocks, the S&P 500 type stocks, it doesn't work at all. And a lot of value stuff doesn't work very well with very big stocks. But when applied to, say, microcaps, it's worked incredibly well. And that's continued to be the case even recently. So, by the way, the thing is just price to earnings times price to book. So he suggests, for instance, in The Intelligent Investor, that you not pay more than 22.5 times the combination of those two factors. So in other words, you can have you can have a price to book of 1 and P of 15. He's okay with that, but P of 15 and price to book of 2, he's not. And it's pretty effective that way. But if you have a very low one, like a 5, for instance, and we own 2 stocks that probably would count as that technically, then you tend to do very well. The problem is that it can't scale up. And I would say read Berkshire's early partnership letters. Now, Buffett underestimated it, but he thought there was no way he could manage a few $1 billion and beat the market. He says that a few times, that if he was running funds like the biggest funds at that time, he could never beat the market. Now, he could, because he started buying things really with C's, shifting into high quality type things. So that changed it. But he couldn't have stuck with the approach that he has. So it's assets under management. The value approach works really well on a small amount of stock. Schloss and Graham both would pay out and to avoid getting too big so that they could sustain it for decades.
So what's a small amount?
Well, a small amount is probably 300 million or less, definitely. And
so there's hope for everybody listening.
And to be honest, yeah, it works at 300 million or less, sure. And the best one would be, and for individuals, this is okay, but the best one would be under the limit at which you have to start revealing everything to the SEC. So whatever that is, 100, 150, whatever, yeah. So that works too, because you will get some coattail riders and stuff in value stocks. Value stocks can be problematic to reveal to people because like certain compounders and things, it's not like people figure it out. You say the stock name and it's not a big deal. When you say the stock name of like a net or something, they just look it up and go, oh, and they buy it. Yeah, sure. It's pretty obvious what it is. So you kind of want to keep secret the names of things that are complete values.
Thoughts on NACCO's quarterly earnings tomorrow?
Not really. I think you will be on the call Friday morning probably.
I think I will be.
Yeah.
Tune in.
Yeah, so you'll get to hear.
A discussion on trend in return on invested capital for companies that have utilized buybacks / have a lot of treasury stock. Thoughts?
I think the big thing, Buffett talks about the test of you have to create $1 of market value for every dollar you retain. And it basically works the same way for buybacks. So it works the same way for acquisitions and things like that. So I would say that the trend has to be that you're creating market value. That's the best way to look at it. It's just another form of retained earnings to me, really, even though it doesn't show up that way. How
do you go about judging whether you are wrong on an investment?
I mean, for me, I'd say whether I'm wrong on an investment is if my original reason for buying it turned out not to be true. Secondly, would be also if I misjudged the risk of like a catastrophic outcome in it. And the third would be if something happened that I never expected that completely changes things. And we've had all of that happen before. The last year, something happened with the company where I would have put the probability of it occurring at extremely low. It was an adjustment to a merger thing, which almost always is very minor. And there's a dispute over it, which was, a huge amount of the merger consideration. And this year, we were invested in a stock that had to do with airline miles. And I sold that when the world changed that way. So it's a mistake in the sense that I didn't take into account the possibility. I mean, we did talk about it. Mm-hmm. What could stop airline travel for a year or more? How many miles could you get stuck with? What would be the financial situation?
Yeah.
But we came up with ideas like terrorism, weather events.
I was just, we did. Like, it was, those type of events, but a pandemic and a national shutdown was just like not on the list.
Yeah, the same. We own
or worldwide shutdown.
Yeah, we own a stock that was shut down completely. The things I considered for it as big risks were things like a tornado or something happening because they don't have that many sites, or an incident, a bad incident that resulted in someone's death or something that ruined their reputation. I did not consider a catastrophic possibility of them being shut down by the government, along with like everyone else for attendance reasons.
Mm-hmm. What adjustments to GAAP earnings should investors make when looking at businesses like Salesforce and Amazon in order to understand the economic reality of these businesses?
I'd focus on the free cash flow.
I was going to say free cash flow.
Yeah.
It smooths it out. I mean, even Amazon has free cash flow, right?
Yeah. So free cash flow. And it just, you have to kind of figure out use Buffett's definition of owner earnings. You figure out how much working capital they need to grow and how much of their CapEx is for growth. Mm-hmm.
Do you consider buying Hunter Douglas a mistake last year, and if so, why?
So I'm not sure I do. I mean, yes, I do in the sense that I bought anything instead of holding cash. But we hold a lot of cash now, and people might say too much cash. So I don't know. It was a mistake in the sense of buying a more marginal stock that I wasn't that excited about versus holding cash. Mm-hmm. But I don't think I don't want to say anything negative about the stock as if it's not a better choice for people than many of the stocks they may own. But yeah, it's a mistake usually to buy a stock that you're lukewarm on just because you want to deploy cash.
What company or industry is not in your circle of competence that you wish was?
That's a very good one. I don't know. There are some technology things, I guess, that would fall under the category. And maybe also possibly reinsurance. Yeah.
Do you think increase in book value is a proxy to intrinsic value growth?
Depends on the company. Some companies don't need book value at all. At other cases, yeah, it is. So it probably is at things where it's either very liquid book value. It probably is in terms of insurers and banks generally. At other companies, it may be more priced. It may be more sales than book that's useful, or gross profits than book.
Thoughts on #SYTE as an investment?
No, I don't have any thoughts. We have a relationship with.
We will never publicly say anything about the company.
I don't own the stock and won't own it because of the relationship. That has nothing to do with whether we like it or not.
Hi, Andrew and Geoff. Thanks for a great podcast. Question: how do you decide how much time and depth is needed in researching a stock? I did hear in a recent podcast a few days of continuous work. However, has there been times where it has been so clear it only took you a matter of hours?
Yes. There have been cases where that was true. We'll see. They haven't always worked out. I mean, I say they haven't always worked out. In some cases, the stock is back at the same level that it was at that time, but it did double at one point or whatever, so you can take whatever you want from that. Yeah, I wouldn't say that I made a decision on NACA right away, but because I didn't know things about exactly the price would be at the spinoff and stuff. But yeah, I read it in a fairly short period of time and was very interested in it. There's some special sorts of things. We've mentioned a little bit on it that I used to do, whether that was things having to do with litigation or like workout type stuff that Buffett talks about. And some of those were immediately obvious, almost arbitrage type stuff, yeah.
Hi, Andrew and Geoff. Thanks for the Berkshire summary. What level of cash do you think Berkshire would hold for Warren to consider the company fully invested?
I think at this point he would hold... he might consider himself fully invested at $50 billion, and it could be even a little bit more than that.
Really? Wow.
It could be more than that, yeah. But he wouldn't at $100 billion, let's put it that way. He would have no hesitation to spend... I don't think he'd have any hesitation to spend $50 billion right now. He might have a little hesitation to spend $100 billion. He really did seem concerned about certain things that could happen in terms of markets freezing up and stuff. You know, in fact, he said, I don't want to say certain things that could happen because you can, you know, by saying them, you can almost make them more likely to happen. Yeah.
Do you have a lower limit for the managed accounts? Minimum capital required, $100,000 US dollar. We can manage trusts, IRAs, taxable accounts, all like that. But the minimum is $100,000.
And that's a real minimum, not like things that do it for marketing purposes. And stuff.
That's a real minimum.
So sorry about that. If you were hoping that that's just to get talking about doing 50,000, that's not a thing we do.
No. How do you address FOMO in the current rally?
Well, I don't experience it, so, but many people do. But it's definitely not a feeling I've ever had.
All right. In terms of buying stocks, do you care if the price is 5 to 10% over your interest price? An example: how patient are you in terms of waiting for the right price in case the stock never gets to your interest price again? Hope that question made sense.
Yes, it does make sense. So two things. One, we have a specific price that we'd want, and usually we would not buy unless it hit that price, and that means we would miss out on a lot. We will be aggressive buying something if we can get a lot of shares of it. What we're worried about is our average cost over time, and we understand that if we want to buy several $1 million of a company that has a really small market cap, we're going to disrupt the price in some way. So we're not big on the idea of, I don't want to move the price to get 1% of a company that we want 10% of or something. We're okay with moving the price a lot to get big chunks. But in general, for what people would normally be doing, I would say we are probably
not moving the price like purposely. Like we're okay paying above the current market price to get a big chunk. Is what you're saying?
We compare it to how much I think will disrupt the price by buying in the open market for that much.
Yeah, I'm just trying not to get us sued. That was just a disclaimer.
Oh, okay. So I just think that for most people that you're not in super liquid stocks and stuff like that, we do have a price. I mean, I have a price always. Even when I write up a stock on Focus Compounding, we have a revisit price, you know? And so there is a price that I'll pay, and then we won't do more than that. You mentioned on the podcast something about Virtue Motors, not the podcast, but what you did with VetLove, Virtue Motors and things like that. We waited for Virtue Motors for a very long time. I had a specific amount of price to tangible book that I was willing to do, and not more than that. It took a long time. I don't know if we waited a year and a half, whatever. We started to be able to buy it. It kept dropping a lot because of coronavirus and stuff after we bought it too. So it's not like we're picking a bottom there, but I had a certain discount to book that I was willing to do and not above it.
I love that their CEO tweets a lot.
Yes.
He tweeted the other day. Yeah, he's big on tweeting. He followed me, but I don't even think he knows that we own a stock. Thoughts on Nuvera Communications?
I do not have thoughts on it, but I believe that Dave Waters of Alluvial would be a good person to look for information on that, I think.
Are there too few high quality small cap companies trading in public markets because of private equity? Does this make a small cap strategy much harder than it was in the 80s or 90s?
I don't have a problem finding really attractive small cap companies. I have a problem finding the prices I like.
Yeah.
So no, I actually don't have that problem. I could think of quite a few that I like a lot, but the price is not what I like.
What does Geoff think about the fund management business as an investment, or is it just a bad business to avoid?
I mean, I think more generalized investing stuff is hard now. So I think you would either want to be doing something super specialized. We do stuff that's super specialized, but also, like Oak Tree or something does things that are really specialized. Or you'd want to be like an index fund type thing or stuff like that. I think it's gotten very hard to be the in-between sort of thing. The idea of these big multi-billion-dollar mutual funds that mostly are pretty close to the market, highly diversified and stuff, I think that's become really difficult.
Mm-hmm. Which filters do you use to make a net screener? And which is the best page for this? Do you talk about net back tests? Where do you do it?
We've done stuff like that a bunch of times. Also, back tests with nets, I should say, are there's a bunch of papers on nets all around the world that's been done all around the world. I actually do nets by hand, checking for them. And the thing I mentioned, I think, was the most important thing for net for me is the amount of share turnover. I don't like to have liquid microcap stocks. Microcap value that's liquid is often not that great. Illiquid is a lot better. Overlooked is a lot better. So I tend to like the nets that are overlooked as opposed to those that are like hated for some reason. I like the Graham number, and so price to book and PE. And I also do like nets that pay dividends.
Hi, Geoff. Would like to hear your in-depth views or insights on dividend investing, either as a dedicated strategy in itself or as a part of your broader portfolio, which may include other themes. And you put in parentheses, growth, value, etc.
I'm not a huge fan of dividend investing just because I think people tend to overvalue dividends. And sometimes people have an objection to selling some of their stocks to create income instead of using dividends for it. And some companies that are very attractive for dividend things know it and pay out pretty high dividends for that reason. Having said that, I've gotten high dividends in some things just because the stocks are really cheap. So
high dividend yields.
Yeah, high dividend yields, exactly. So like Peter Kundal talked about the magic sixes back in the 70s, which were a PE of 6 or less, a price to book of 0.6 or less, and a dividend yield of 6% or more. If you find a stock like that, that could be very attractive. Mm-hmm. But if you find a stock with a high PE, high price to book, and it has a dividend that you like, I don't know. Dividend growth and consistency in dividend is probably more important than the yield to me.
When, if ever, is return on assets a better metric than return on invested capital for the next decade? MO or PM? Why?
I don't think I have a strong opinion on that because I don't know enough about the differences in different countries about tobacco usage and stuff. It's just not an area I'm knowledgeable about, I think.
Return on assets versus return on invested capital?
Return on assets can be a more conservative way of doing it.
Depends on the business, though, as well, right?
Yeah, I mean, sometimes it doesn't. Sometimes return on assets can be as accurate as return on invested capital. One way where it will definitely be better is with banks.
Yeah, I was gonna say that.
Yeah, no, that will definitely be bigger, but I doubt that's what he's looking for. But yeah, banks will have a better number. That's a bit more. That's return on assets is the most useful number I find with banks.
Yeah, but other companies, I think return on invested capital is probably better.
Probably, although what I do is return on net tangible assets, which looks a lot like what Buffett does, and mostly what I care about is receivables, inventory, PP&E, and then accounts payable and accrued expenses.
Mm-hmm. What are your thoughts on McKinsey's valuation textbook? I've noticed it was on the bookshelf in the older videos.
I have not read it. It was in your office, right?
Yeah. I've read it. Yeah, I mean, I don't know. Read 10Ks, I'd rather. I mean, it's a good, sure. If you want a good foundation, I wouldn't really. It's a good book. There you go. I'll say that. After a brutal 8 years, is it finally time for gold mining names to outperform on a sustained basis? Gold price higher and main input costs lower. Oil, EM currencies weaker. Expense side, capital allocation much improved. Underrepresented in institutional portfolios?
Yeah, I don't know. It is an interesting question that people buy a lot of gold and not gold miners sometimes.
And they linked Paul Singer, Elliott Management, called gold one of the most undervalued assets around as hedge funds bet big on the precious metal.
Yeah, I don't know. We wrote up A-Mark Precious Metals, which is not a gold miner, but it trades in gold and stuff, and it could be attractive if there's a lot of volatility in gold. And I'm not going to suggest ways to get hedge that and stuff, but if people want to invest in things that relate to gold while taking out the risk of gold actually, the fact that gold might fall down a lot and stuff like that, that one's probably better. It's not as exposed to gold prices themselves. I don't have an opinion about gold generally. If you look long term over comparing it to other commodities, I just don't think it's very cheap compared to other commodities. I don't know what that means, but that does worry me. That if it's a higher ratio.
What resources would you suggest your listeners to use to improve our valuation skills? Where can we learn about the valuation method used by you? Well, if you join FocusCompounding.com and use the podcast promo code, that'll take $10 off of the subscription price, and you can see how Geoff values companies when he writes them up.
Yeah, I guess that is the best way. Yeah.
But yeah, other than that, I mean, Value Investors Club is good when they lay out their valuation, even though they may focus more on like the next 1 to 2 years. But if you want to,
blogs are pretty good.
Sure.
Depends on the blog.
Yeah.
But like I mentioned alluvial before and stuff. That blog, OTC Adventures, is good at laying out some sort of way of trying to value it and a different approach on each kind of stock.
But reading online, just reading case studies, I would say. About CVNA, it have a disruptor valuation in a business that seems not to be. What do you see as a differential value proposition? The growth they could be due to auto loans, ABS, like the subprime bubble.
I don't think I know the company.
Yeah, I don't either. Do you consider the stock compensations expenses as non-cash expenses?
I actually do. I look at it in terms of the amount of dilution that happens and then factor that into taking it out of my return. So what I do is I actually look at a very long-term history of the company and things like that and try to guess how much I think they'll dilute me over time. And in a lot of companies, it's pretty big. It's often as high as 1% to 2% you're going to find. So if I think that I'd return, that the business is going to give me a 10% or something return, then it's down to 8 or 9%. So I basically add it to my hurdle rate in a sense. There are companies I've skipped completely for that reason of that compensation. But no, I don't. I actually don't treat it the way most people do, which is like actually an income statement thing that's taking out of earnings. I just look at it in terms of dilution.
Is TLSA a short? Is that not Tesla though? Because I know there was a stock that went like parabolic because of Tesla. Hold on, let's see.
Oh, it's like
there's like one of them. Yes. Okay, so that's Tesla. No, that isn't Tesla. Well, I don't know what he's saying. He could be saying about this stock. There was one that was going crazy before, but maybe
why don't you search instead for TLSA stock, the one underneath it? No,
that's Tesla. Yeah, but there was one that went.
If you type that in, and then you pick the second thing, show instead.
Which one? This one?
That one, yeah. Let's see if there's such a stock.
Yeah, see? Let's see. So, yeah, maybe he's talking about Tesla. But there, it may have been this one that was going like crazy.
Because people were confused?
Yeah, at one point. Maybe he's talking about
like
Tesla,
Zoom.
though. Yeah, Zoom. I think the SEC actually shut down one of those or stopped trading in one of them because of that, because one was just going bonkers. Let's assume he's talking about Tesla. Is it a short?
No. I wouldn't short a stock.
Is it a long?
No.
So is it do not touch?
Yeah.
Cool. We're not short sellers, so wrong people to ask. I know in the past you guys did a write-up on Cool, KEWL, when it was around $100 per share, but didn't buy. It's at around $60 now. At this price, does it make it more interesting of an investment?
It makes it a lot more interesting investment, and there's new people involved who are pretty candid and give a lot of information that could be helpful about it. I've been reading the reports and listening to everything that they've done, and we'll see. Yeah, it's more attractive because it's a lower price.
Most people have a list of things they look for in an investment to invert. Do you have a list of deal breakers that help you screen out companies quickly right now? An example, high debt, high capex in an inflationary environment, etc.
I don't know about that. There are a lot of businesses I can't understand, so those are out. Certain managements that worry me a little bit, and some stuff about debt might be true, yeah. I mean, yeah, I was just looking at a list of companies that are like oil producers, and a significant number of them had high debt while having no cash flow. So that would be a deal breaker. I can't imagine a company where I invest where they have negative cash flow from operations, if you want to use that as an example.
When do you think the market will tank again, and why?
I don't have a clear view on that.
What's the format of your paid membership? The Snowball talks about how Buffett used to scan equities by hand, Value Line, and S&P stock guides. What are your thoughts on doing this? And 3, how do you account/think about minority interests?
Oh, wow. So the format of the paid membership is that you pay $60 a month and you get write-ups by me.
Yep.
And there's also a list. You get a backlog of like 100 that are already in the archive. And then you get additional ones. They're usually about a few thousand words. At the end, I give a interest level from 0 to 100 of how much I would be interested in buying it or something like that. And I give a price where I'd revisit it. Occasionally, there's one that I really like right now, but most of the time, it's one that at a lower price I'd be interested. Yes, I think scanning by hand is great.
Cool. Well, I want to thank everybody so much for tuning in with Geoff and myself on this week's Q&A. Be on the lookout for the next Q&A. Follow me on Twitter at Focus Compound. Also, if you would like to support Focus Compounding and you like QuickFS, that is quickfs.net, which is the website that Geoff and I use every single day to look up stocks, pull the financials. You could pull the models from there, which is really nice as well. Long-term ratios, long-term financials in a very clean manner. You could either click the link in the show notes, or when you sign up for a membership at quickfs.net and it asks you where you heard of QuickFS, if you click Focus Compounding, we will get credit for that. I want to thank everybody so much for tuning in with Geoff and myself. Hit the subscribe button, thumbs this video up. Know that a review and rating goes a very long way for us, and we will see you in the next podcast.